about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts to the show then. Sangeet Lakkar of Newberry Capital, T.S. Harihar of HRBV Client Solutions, and Kalra of Target Investing join me on the show. Thank you to all for joining me. Today on Hot Money, we'll discuss stocks like the paint sector. Both Asian Paints and Kansai came out with numbers which disappointed, and with disappointing commentary. What should one do in the paint sector? IndusInd Bank fell in because of the exposure that it has to IL&FS and the rights issue that didn't go through. So that's another problem for IndusInd Bank. What should one do? Has Dish TV lost its plot? Is the business model actually under threat given the fact that what's happening with the Jio Giga Fiber? And Page Industries has corrected all the way from levels of 3,600 to now 28,000. But are valuations still expensive, or is it worth getting into Page Industries at this point of time? So those are the stocks that we'll discuss on Hot Money today. Let's discuss the first stock, and that is the paint sector. Asian Paints came out with numbers after market hours yesterday. It's reacting to its numbers today. The counter fell in even more when the management commentary wasn't the most encouraging. Kansai also was down significantly in trade yesterday, post a poor set of numbers and poor commentary. But paint companies in most cases always trying to trade at a premium valuation, and that's been the case especially with Asian Paints. What's the view on the paint sector, and what should one do going ahead? We'll ask our guest. So Sangeet, I'll start with you. What did you make of the numbers, and what should one do with the paints industry?
I think both the numbers were on expected lines, I would say. The margins for Kansai and Aerolac dropped by 400 basis points, whereas for Asian it dropped by about 150 basis points. And the same can very well be explained because Kansai has an exposure to the industrials and automotive segment. Now, for them to retain margin, it is important for them to pass on the cost escalation to the end customers. It has always been difficult in a rising cost environment to pass on the cost pressures to the customers in case of an industrial and an automotive paint segment, which is more B2B. So you'll have to go with paint companies which are more into decorative segments and B2C, because they can easily pass on the cost escalation to the customers.
Okay, so you prefer Asian Paints will be a better bet here?
So at the current valuation, I don't think the valuations have significantly corrected to warrant a buy. But if I have to buy amongst the two, I would prefer Asian Paints.
Now what about Berger?
Including Berger and Asian Paints. So the pecking order would be Asian Paints, Berger and Aerolac.
Okay, so basically it's basically a B2C bet that you're doing in rather than a B2B bet which Kansai does at this point of time.
Correct.
Hari, would you agree with that point? Would you take a B2B bet or a B2C bet, or you still believe that valuations are something that are still steep for both these sectors?
No, I think valuation is a concern, especially if you look at the B2C companies like Asian Paints. I think historically Asian Paints is quoted at a very rich valuation. I think that's been the case all along. I think but that was fine as long as we had these oil prices coming down from $130 to $30 and staying low. But I think if you look at it in the last 1.5 years, oil has gone from about 40 to 80. The prices of titanium dioxide and zinc oxide, two important inputs, I think both of them have gone up. So I think next 2 or 3 quarters, I would believe that the input cost pressure is going to be there, and we have seen a 1.5% fall in the OPM this quarter, and I think they could face further pressure in the coming quarter. So we generally tend to be a little negative in the paint sector, both the consumer and the the industrial paints, and we believe that we could see more compression in the quarters to come. So we would probably stay off paints for the time being.
Okay, stay off paints at this point of time. What about you, Samir? What's the view that you have on the paints industry?
So we believe the crude prices are still has more leg up in terms of rupees as well. So for us, in terms of rupees is much more important, because titanium dioxide, a lot of import factor is there. So that has been a double-edged sword for these guys in couple of quarters. Now if you see, the 14% price rise has already been there in crude prices in rupees term this month. So that will translate to another 5 to 6% rise in titanium dioxide. So I think that passing on again was a factor due to the GST cut which they received in July 27th. So that was a factor for them to be pressurized. The most negative which I've seen is the decorative volume growth, because even in the pre-season buying of the inventory stock up, they were not able to push up around a 15-16%. That means somewhere the inventory built up is kicking in drastically for the consumer sector as well. So I think it's better to stay away from the sector as well for a couple of quarters before this situation gets revisited.
But the expectation never was of 15-16%. I think the street was anticipating 8 to 10%. They've done close to 11%. That's something that they said.
See,
and this comes on a higher base of last time. So
see, the only point I'm saying is I don't know what the street was expecting out of it. Half the things they were expecting never got met, even on the downside of the numbers. I'm expecting, because these pre-festival buying becomes much more of an inventory build-up, because the Q3 will really hurt you on the downside. The volume growth will actually come off very drastically. So if that trend comes out in the Q3, I think then the sector has much more pain left in the system.
Okay, Sangeet, you agree third quarter will be even tougher for them given how crude has panned out and is continuing to grow up. Rupee it doesn't showing any kind of major signs of a reversal. Raw material cost will go up, and they said that they don't have the pricing power to push up most of the prices to the customer.
I am not worried more on the input cost bit, because historically, if you've seen, we have seen crude even at $150, and companies like Asian Paints were able to protect their margin. You know, it's very easy for somebody like Asian Paints to just pass on the cost to the end customers. I think the festive season also is delayed this year, so maybe that's why the growth wasn't reflected in the Q2. Q3 I think should show a decent growth, but I mean over a longer term period, I would prefer companies which are having those pricing power, which is into decorative segments, Berger and Asian Paints for that matter.
Okay, so that's the view that's coming in on the paint sector. I think the consensus view that we're getting in from all of our guests is that it's time to be cautious on the paint sector. Valuations, the correction has happened, but the valuations still are not that cheap that it warrants a buy. But if you want to take a bet on the B2C business, which is something like an Asian Paints or a Berger Paints, which move directly to the customer, rather than a B2B, which is mainly Kansai, which caters to the automotive and the industrial business. So that's the trend that's coming in on Asia on the paint sector. The second stock, and that saw a surprising 8% drop in trade yesterday, has managed to recover today, but that also has come up from the highs of the day. Now the concern for IndusInd Bank are multifold. First of all is the exposure to IL&FS. Still now the management is not giving any clarity what the exposure is. Brokerages put that exposure to be 2,400 crores. And they have just provided 275 crores provision of it, and they believe that this could be done. But the IL&FS issue certainly seems to be looming around the neck of certain of these banks. So what should one do with the IndusInd Bank? Is it something that you should accumulate, or would you be concerned by this big exposure that the bank has? Samir, IndusInd Bank, is IL&FS a big concern, or is it fully played out now?
It's not fully played out till the time the exact exposure comes out. That's what worries us in the medium term. I think till the time the plan of revival of IL&FS comes out and they put it in the next quarter, or I would like to see the provisions they do for the next quarter. That will give you a certain kind of estimate that these are still going up in numbers. So I think that worry is still there, but on a longer term, a Bharat Financial merger is what I'm betting on. But we're not adding any positions on this kind of a downfall even right now, because the valuations are still stressed.
But I believe you were bullish on IndusInd, and the reason that you had said earlier was the Bharat Financial merger.
Yeah, so I'm still bullish on it. The medium term adding another weightage right now to IndusInd is not warranted, because the exposure to IL&FS is not disclosed.
Okay.
So if that comes out to be a 2,400 or a 2,500 and they have to provide it in the next 6 months, I think the numbers will be suppressed for a couple of quarters.
Okay. So you're not adding anything more to
So
IL&FS?
we've holded the weight we had previously, and our average is around 1100. So I think we are still sufficient over there, but we are not adding weight on this kind of a downfall until unless the clarity comes on the numbers.
Okay, Hari, what do you make of IndusInd Bank? What should one do?
No, we were a little disappointed with the, I would say, lack of transparency over the IL&FS exposure. And let's not forget that the IL&FS exposure overall is about close to $1 trillion. And what we understand is that roughly about 60% of that is gone. So even assuming that all the projects of IL&FS put together get about 40%, that is about 60,000 crores gone. And I think at some point, people need to realize where that 60,000 crores is going to hit. Which banks it's going to hit, which companies it's going to hit. So I think it's no point hiding it. And if 2,500 crores, I think, as the reports are floating around on WhatsApp is correct, I think it's going to be fairly large. Assuming that 60-70% has been provided for, I think it's a fairly large hit on the bottom line of IndusInd Bank. And my worry is not that. My worry is if IL&FS gives a hit of 60,000 crores, there could be 40 other companies that could have a collateral shock. And IndusInd could have exposure to all these companies. Because IndusInd, unlike an HDFC Bank, has a fairly questionable portfolio at some point of time. Its exposure to NBFCs, exposure to bonds, which is not too transparent. So we are a little cautious on this bank. Again, we loved HDFC Bank results, so we would probably prefer an HDFC Bank or RBL. IndusInd is something I would probably stay off. Okay.
Sangeet, just coming back to you, are you concerned about one of the other concerns for the IndusInd Bank was the growing exposure to commercial real estate, the growing exposure to some of these mid-sized companies, to the companies in the gems and jewelry sector. Are you concerned about, let's leave IL&FS aside, are you concerned with the asset quality problem that could...
So see, if you see historically, that asset quality hasn't hit the books. Now if the systematic issue due to IL&FS kicks in, then it's for all. Then how deteriorate the asset quality becomes for IndusInd or a Yes Bank or a Axis, that's more comparative then. So I think on a standalone, I will not give that valuation premium to that kind of a portfolio, but I'll not give a valuation discount to that. So I think I'll still benefit on that Bharat Financial and the other CV sales which are being prospered. So over there, these kind of benefits are still there.
Okay, Sangeet, what's your view on IL&FS with all that's going on?
From IndusInd.
From IndusInd.
So I think the valuations are now coming in an attractive zone, I would say. You will never get valuation and good news on the same side. So you have to either buy the two. So I would buy the valuation in this particular case. The brokerages are putting out the total exposure at 2,400 crores, but the exposure is split between two large assets. One is the road assets, and which is AAA rated. And the second is the bridge loan which they have given to the parent company against a rights issue. So we don't know still what eventually will hit the balance sheet, but just on a larger point, I mean, if you see in a rising interest rate scenario, the banks which are having low cost deposits will benefit. IndusInd enjoys about 45% CASA. All the banks which are having a very high low cost deposit should be should benefit to a larger extent. Also, the underwriting quality has been very robust. The NPAs have remained very in a tight range. The only concern for me for IndusInd will be probably succession. I am not worried about much about the IL&FS loan. There could be a one-off hit or something. But if you see over a period of time, the lending quality has been very good. The asset quality has been pretty good. The liability side is very strong. And the valuations are now appearing to be reasonable to me. So I would go with IndusInd.
Okay, you like it. Anything else that you like? Is this your top pick in the private sector bank, or do you like something else?
I like a small bank like a AU Small Finance Bank. Again, very robust underwriting practice. CASA has been growing phenomenally after they got their small banking license. And the asset side also looks pretty stable to me. So these are the two.
Okay, and just to come back to the point in terms of the succession plan, that's is that a big concern for you? And secondly, the asset quality, because there are now question marks to commercial real estate, NBFC loans, to gems and jewelry. So just two questions on that.
So in terms of succession, I mean, I would be, Ramesh Sopti has displayed, over a period of time his skills, and he's brought up the bank to this level. So obviously the top management change is something to watch out for. In terms of asset quality, I think June asset quality was pretty stable, barring the one-off provision which they did. So I would not, the September asset quality. So I would not like to preempt anything that the asset quality is going to worsen, in coming quarters. If it's so, then we will review it that time possibly.
Okay, so that's the view that's coming in on IndusInd Bank. Samir already owns it, but he wouldn't average it at this point of time. Hari is saying that HDFC Bank is something that would give him better valuation, and Sangeet is saying that at this price, IndusInd is not a bad bet at this point of time. So that's the view that's coming in on IndusInd Bank. The next stock is a stock which has fallen significantly. Dish TV. Now, ever since Reliance announced the Jio fiber thing, it's been falling. It kept on falling. Then the bad news came in terms of Reliance buying in both stakes in both DEN networks as well as Hathway. So I think the entire problem for Dish TV, one of the biggest problems is how Reliance is going around, and that will take a lot of their turf. So is the business model something that is under serious threat for Dish TV? That's what we're asking. Hari, you believe the business model is now under serious threat for Dish TV?
No, I think it's already under threat, and I look at Dish TV more like the Nokia versus Apple story back in 2007, 2008. I think what we need to realize is that the incremental growth on television today is coming predominantly from mobile television, not from what we call the static room televisions that we all watch. So this whole concept of DTH coming and revolutionizing, which is the story we all heard for the last 10 years, I think that is the story we're going to forget. And if we forget that story, then the question is what remains of Dish. So I think at some point, Dish will have to probably say that, okay, we are getting out of our traditional model fully, and we are probably going to get into digital. So that's a call they'll have to take. But even if they get into that, I don't know to what extent they can compete with the kind of a muscle power that a Reliance Jio has. So that's a big question mark. And I think the second part is there were a lot of hopes that the company would benefit from the synergies between its parent Z and the DTH business. But that has hardly really helped the company substantially. So I would believe that the model that the companies came up in the first place, I think that is under question. And we know the aggression that Reliance Jio has, the way they have kind of reformed the entire telecom space, and I think media could be the next space we are looking at. So we would be very, very cautious on stocks like DTH. Okay,
DTH. So will that include Sun DTH, or would that be, because they also have a little bit of exposure?
Obviously, I think among the listed there are only two. There is Sun and Z. So I think we would be cautious in both. Tata Sky, of course, not listed, but we would be cautious in the entire space.
On media spaces, such as. What about you, Sangeet? You agree that Dish TV's business model is now they need to do something else to survive?
So I think more than Reliance Jio, I think structurally the OTT players are a bigger threat to the DTH players. Reliance Jio will put that pricing pressure possibly, but understand that Dish TV's forte is their rural customers. It's 75% of their customer base is rural and the row houses, whereas Jio is going to target the high-end urban customers because of the FTTH. So, but yes, I would not be a buyer in Dish TV because I don't see I think the entire media space is prone to disruptions, from the OTT segment, and Dish TV does not have any other segment to bank on to, So, and plus it is loaded with debt as well, so it's not good. It's a very capex heavy business. I don't think they'll be able to generate free cash flow sustainably over a period of time.
So if you're betting on OTT, would you be bullish on ZTV in that case?
No, I think even in the OTT space there is a lot of competition from the overseas players also. Z again, OTT, they have just is something which they have just started into. And they do have plans to invest a significant amount into this, but still I think Z is more of a broadcasting play, which is prone to a disruption. I would wait for a while.
In what way disruption? In what way?
The broadcasting business is prone to disruption from the OTT players.
From the OTT players only. Okay. What about you, Samir? Dish TV?
So not a buyer. But looking at the quarterly numbers, as he talked about the synergies, if that synergies plays through, then I would be interested. I don't think so in the shorter term the disruption will be that drastic. Yeah, the re-rating might kick in, and I think some part will actually kick in when the launch happens and the price plan comes in through Jio. So I think over there, but still standalone, it has a lot of subscribers. I we are just seeing the cash flow generation. If it improves, then I think at a certain valuation might take a small weightage into it.
Now, what's the trigger for Dish now going ahead?
So that's what I'm saying. So the synergies which come
from Videocon,
yeah, from the Videocon, that has to reduce the debt and the cash flows. If it increases the cash flows, then we'll be interested in that.
So, but what about the concerns that others put out in terms of OTT? In terms of
OTT, if you see Netflix today, it needs $1,000 per customer to make it break even. The cash burn in OTTs is way much higher than people estimate. So over there, it's a continuous investment, like DTH was a continuous investment 10 years back. There were a lot of hardware investments which were done. So I think that is over for them. Now OTT needs to do a lot of content investment, which is very heavy in a certain sense, and your customers are switching between the subscriptions. So I think over there, the loyalty and the feasibility of that business model is still not done by even a Netflix. So I am not that interested. Yeah, as a viewer, I am overall optimistic about it, but I don't think so in the shorter or medium term it will hit that drastically into that system.
Okay, so that's the view that's coming in on Dish TV. Not the best of views coming in from our guest at this point of time. There could be more potential downside. And the final stock we want to talk about is Page Industries. It's corrected all the way from levels of 36,000 right up to levels of 28,000. Is down 1.5%. Again, valuations, again, something that are of a concern for Page Industries, but remember, it hasn't corrected as much as the other consumption themes has. So are valuations now attractive for Page Industries or still on the expensive side? Sangeet, what do you make of Page Industries?
As a business, it's a quality business, so at every bad news or at every correction, it's a buy for me. If you just see the numbers, the growth rates, the return on equity has been upwards of 40%, whereas if you see the second player, all their metrics would be, the return on equity would be about 20% or so. The business is growing at about 30% for them. I think over the years they have been focusing on the men innerwear segment, which the management last year pointed out that from now on they will be focusing more on the sportswear and the women segment also. Because globally, if you see, the women innerwear segment is much more than the men segment. So that's another focus here, and that's where the growth has also been coming through. If you see the last quarter results, the women segment grew by I think 20%, and the sportswear also grew by about 23-25%. So it's a quality business. I think the only concern for me for Page is promoters has been intermittently reducing their stake. So that is something for me to watch out. In terms of business, I don't see.
Valuation wise?
Valuation is expensive, but again, that's why I'm saying any bad news or any significant correction is a buy for me.
Hari, what do you make of Page Industries?
No, we would probably stay off, because we have worries over the kind of value addition that a company like Page can really do, and for that kind of a value addition, giving a very steep price earnings is probably not really justified. And let's not forget that today, if you look at the correction in the market, the stocks that are actually getting hit are the stocks that are richly valued. Look at DMart. DMart at one point was 118 times earnings. I think today it's gone about 35% of it, still 86 times earnings. So, companies that had stretched valuations, I think those are the companies that are really taking a hit. So, I would believe that probably Page Industries will also come in that category. Valuations are probably just too steep. The business model may look sustainable at this point of time, but it doesn't take too long to change. So, we would believe that ROEs of 35-40% are not going to be sustainable, definitely. So, we would probably stay off the stock for the time being.
Okay, so one, buy on decline. Secondly is stay away from it. And Samir, finally, what's your view on Page Industries?
So we'll avoid it. The business model and the numbers which Sangeet has mentioned are, on paper very good, and they have been sustainable. But I think now ahead the valuations are at a point, or even the sentiment is at a point, that even a slight disappointment will give you a more downside to the stock rather than any kind of a positive upside movement. So I think rather stay away. Maybe it could have been a good around 20,000 or 18,000 kind of a value. And I think there's further downside or a disappointment. If it kicks in, it might take it over there. That time it can be reviewed. Okay,
Sangeet, do you want to respond? Growth concerns, is there something that you share?
I don't think so. I mean, quarter on quarter, if you see, they have hardly disappointed. I have no reason to believe, because they operate in a, so they have created a unique brand for themselves, and being a low value item as such, it's very difficult for people to trade down. you know, whenever there is a repeat buyer or whoever, you know. So I think they should add more and more customers. It's more of a value migration story, I would say. You know, so and we will see quarter on quarter, but they haven't disappointed so far. So,
okay, so that's the view that's coming in on Page Industries. Two of our guests believe that it's an avoid at this point of time. What Sangeet is saying that it's a buy on every bad news or a decline that probably comes in. But with that, we're completely timed down on today's Hot Money. Sangeet, Harihar, as well as Sameer, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.
Good news, guys!